You're listening to the Gorilla State Investing Podcast. We're not here to bruise your bananas with guru sales pitches, overrated fluff, or any other kind of monkey business. We simply provide the ground-pounding truth about what it takes to be successful in real estate.
All right, today's guest is Charles Seaman, a personal friend of mine. Charles and I have been on a podcast before together. Charles is the manager and senior acquisitions manager at Three Oaks Capital. Started out in Brooklyn, New York, and now lives in Charlotte, North Carolina. Charles has 14 years of commercial experience and actively syndicates throughout the southeastern portion of the country. Charles, how you doing, brother? Good to see you.
Ramsey, awesome. Thanks a lot for having me.
Yeah, man, it's been a pleasure. We were on Brian Briscoe's Diary of Apartment Investors podcast.
Correct.
Together.
Yep.
That was my first real estate specific podcast I was ever on. And you were my experienced investor and I was the noob.
And now it's come full circle where you're the host and I'm appearing on your show.
Yeah. Well, I'm still gonna pick your brain, even though and honestly, that's why I started this show, so I could pick guys like your brain and grow from it. But why don't you go ahead and tell us how you guys started in real estate, kind of catch us up to where you are today and elaborate on the intro a little bit.
Absolutely. That sounds good. So for me, my approach was probably a little bit unconventional and a little bit different than some others. While others were actively seeking out, I kind of fell into it. And at 20 years old, when I first became exposed to commercial real estate, I tell people I was young, dumb, and broke. And it wasn't so much that I was in need of something to go out and find passive income from or something to go out and create wealth from. It was something I was in need of finding a job at that time. And the job that I wound up finding was for a guy I was a friend of the family of, and he owned multiple different businesses. And when I first started there, I really didn't know what I was going to be doing. And even after a few months, I still wasn't really sure. It kind of took a while for it to set in and figure out because it seemed to shift pretty regularly. But the good news is he had multiple different businesses. And one of those businesses was commercial real estate. And he owned multiple different properties, which I was fortunate to be involved in helping him acquire many of them and helping him operate and manage them. So that it gave me some really good experience. And of the different businesses that he owned and operated and that I was involved in with him in different capacities, I enjoyed the real estate side the most. And that was the one I always gravitated to. Now, there were other businesses that I also got exposed to in other industries, and I'm grateful to have had that exposure to different industries. But what I liked about real estate was that there's problems in any business. But I find the problems in real estate to be more manageable. And to me personally, I enjoy commercial real estate more than residential. So when I first started there, I was 20 years old and I didn't really have any expertise at all. But I was fortunate to work with the guy that was very experienced and to learn a lot from him and to be able to benefit by, gaining some of his wisdom. So ultimately, I wound up having a mentor that I didn't anticipate. And at that time that I probably didn't even realize I needed. And that taught me a lot about the space. So fast forward a little bit to, 2014 or 15, I'd been at the job for almost 10 years. And when I first started there, my intent wasn't to stay there and really make a career out of it. It was to stay there for maybe 2 or 3 years. But as often happens in life, sometimes you get a little too comfortable.
Yeah.
I started making a little more money. I started getting more responsibility. It got to the point where I was helping him manage all of his different businesses and properties. And, to an extent, I probably forgot what I initially set out to do. So around 2014 or 15, I thought, well, maybe it's a good time to start looking into some different investments of my own. And at that point, I knew that I didn't have the budget to go out there and invest in commercial real estate. So for me, my thought was to start with the residential side, to start maybe with some residential assets, and also to start with some wholesaling to just bulk up my capital reserve. And what I quickly determined after a few months was two things. One, I didn't really have the skill set to be successful in residential real estate. Not to say that I couldn't have developed it, but it would have required me developing a new skill set from the one I already had. And two, I really didn't enjoy it as much. I like the commercial side better, for different reasons. One of which that I just like the idea of doing bigger deals. I think it gets me more excited personally, and it's something that gets my creative juices flowing. Whereas residential just feels more blah to me. And that's not to disrespect anybody in that space, because there's obviously a great value there as well, and it's just different things for different people. So fast forward a little further, 2016. That was the first time that I got exposed to syndication. And that was what gave me the idea and said, you know what? I can use the skill set I already have, and I can do commercial deals, and I can do them using other people's money. So all of a sudden, that gave me a brand new horizon and some new perspective. And then from there, in 2017 and 18, I took some different courses on syndication, learned a little bit more about it and how it worked.
Which courses were those, Charles?
Yep, they were actually RE Mentor. So one of the many different trainings out there, but they've been around longer than most. And on the real estate side, I can't say that I learned too much new there, because the good news is it reaffirmed what I was doing in my day job already. So at least I learned that the way I was doing things was the right way. And what it also did was taught me a little bit about the capital raising side, because that side was brand new to me. The guy that I worked for used his own capital, so he didn't need to go out and syndicate. So that was a brand new approach, because that was something I knew that I would definitely need. So as I started taking the courses, little by little, I started putting more and more time into syndication. So initially, when I first started doing it, I was probably putting 10 to 15 hours a week in from mid 2017 on. But depending on the week, I was working anywhere from 60 to 90 hours a week in my full-time job. So what I learned at that point was that more important than the amount of time I was able to put in was just being consistent. And some days you may only have 15 or 20 minutes to put in. But you know what? Put it in anyway, because it's the effort and the behavior and the repetition that starts to add up and starts to take hold. It took me almost 2 years, but we finally closed our first multifamily syndication deal in September of 2019. And now we have 3 deals with 204 units. And we currently have 3 more on the contract as we're recording this.
3 under contract right now?
Right.
Wow, man. So what do you think was the biggest? You went from working for somebody who was well capitalized, and you pretty much did their day-to-day operations, I'm guessing, side of things, where management. Were you actually doing any type of maintenance, or were you just scheduling all of the parts and pieces?
Definitely scheduling. I can coordinate. I can order materials, but you wouldn't want me to touch anything with maintenance. I can barely change the light bulb.
Fair enough. Well, okay. So basically that taught you how, not the what needs to be done, but who it is that needs to do it. Right. So
right.
It gave you a pretty good understanding of the need to delegate or build teams and stuff like that. And I'm guessing that leading into doing syndications, did you go right into capital raising yourself, or did you partner with people who were capital raisers?
For me personally, we have another guy on our team who does the investor relations side.
Okay.
But we routinely do partner with capital raisers, because one of the things that often happens in the syndication space is that it takes you a while to establish your investor network. And even if you're actively working at it, there's a good chance that unless you already have a pre-existing network that is used to giving you capital for different ventures, that you'll probably have to take some time to really warm them up. And there are people that will literally follow you for years, 2, 3, 4 years before they'll ever put a dollar with you. And the reason they do that is they want to see that you're serious and that you stay around, and they want to see that there's a high probability of their capital being returned. Some people will invest with you sooner, but really it is going to take some time to build that base where people feel that they know, like, and trust you.
So you never bought a rental property before doing a syndication. Is that correct? That's correct. Okay, so you're one of the few that jump right into syndications, and it blows my mind, because for me, and this is probably a limiting belief of mine. Well, let's just say this: I didn't know what syndications were when I first got started in real estate, but to me, the progression was single family, duplex, quadplex, small commercial, and then now getting into 20 units, 50 units, all the way up. But what was your first syndication? How many units was it?
92 units.
92 units. So you're almost at 100 units on your first deal. And were you the lead sponsor on that, or did you partner with another sponsor?
We partner with another sponsor. So one of the things that I would tell most people starting out in the syndication space is that unless you have the net worth, which, from a loan perspective is going to be an amount that's equal to or greater than the amount of the loan, the liquidity and the experience, you're going to need to partner with somebody else starting out. And most of us lack at least one of those three things as we're starting out, because even if you have the financial qualifications, there's a good chance you don't have the experience. Yeah. So you'll need somebody else on your team until you have that track record, until you have that financial strength. So for us, we did partner with another group, which in this case, they were very helpful to us. And overall, we've been fortunate to partner with good sponsor groups. So we're very, very happy with that. But on our first deal, the sponsor was ironically the one who found the deal, and he brought it to us instead of the other way around. And the reason that happened is because we were bringing him deals on a pretty regular basis about a year before that. And we submitted offers on quite a few, but for one reason or another, they didn't get accepted. And he knew that we were serious, and he knew that we were actively looking. And it was a 92-unit deal in a market that he was looking in regularly, so he knew it really well. But it was also a deal that he had no interest in because he was doing 2 and 3 and 400-unit deals at the time. So he asked if we wanted it. And initially, when we looked at it, we checked the numbers out, said, okay, everything looks good. And then from there, we decided to move forward with it. So it was really relationship building and consistency that led to our first deal.
Now, is that something that sponsors normally do? Because they kind of graduate themselves, right? Like 100 unit. All right, now I'm going to get into 200 unit. And they get that credibility. They build up their network, and now they're cash flowing. Their capital raising comes in a lot easier. But it doesn't mean that the deal flow stops and they don't get smaller unit deals sent to them that maybe don't pique their interest, but they have guys like you that they know. Is that something that happens normally with sponsors, that they say, okay, this isn't big enough for me, but you guys might want to do it and I'll sponsor you?
I wouldn't say normally, but what I would say is that it really depends on the sponsor, because keep in mind, it's definitely not anything the sponsor's obligated to do.
Yeah.
But some of them do it just because they like helping. And for them, that may be the way they have, time and focus to give back. So they may be helping somebody else and just kind of paying it forward, for lack of a better term.
Let me ask you, what is the main role? So let's break a syndication down into kind of the roles and responsibilities. The sponsor, the KP, the underwriters, all the different roles that there are. And then if you wouldn't mind kind of elaborating a bit on what they do and how a syndication works.
Absolutely. So there's definitely a few different parts. I think you could probably divide it into, really 5 different pieces. So your first one is going to be finding the deal and doing due diligence and basically organizing the deal and really checking it out. The second one is going to be providing the risk capital. So the risk capital is the EMD money. It's all the money that you're going to lay out from the time your LOI is accepted up until you close. So it's the money for the EMD. It's the money for any extension that you might have. It's the money for the loan application, the money for the attorney fees, and any other fees that are laid out between LOI and closing. Another role is capital. So obviously a very important role, because nobody's doing deals without capital. So you need to have somebody on the team that's bringing money in, and that's going to be a very important role. And then another one is loan sponsorship. So loan sponsorship is done by the key principal or key principals, and those are the people that are signing on the loan and basically taking the guarantee. So even though many loans in the deals that we're looking at are non-recourse loans, there still are personal guarantees associated with them. But what happens is they typically won't kick in as long as you don't violate what they refer to as a bad boy carve out. And that basically means that if you run the deal poorly, you're generally off the hook. But if you do something crooked, you're probably going to face that personal guarantee.
Okay, so that's all about ill intent. That means that they can come after you, right?
Right. So those are really your big components. And then the last one is asset management. So the first four take a more active role leading up to closing. And then after closing, asset management really takes over. And that's the key one at that point.
Okay. And now, can one person be fill multiple roles?
Absolutely. So one person can definitely fill multiple roles, and they could probably even fill all roles. But what I would say is they'd have to be well capitalized and have some good systems and good teams in place to be able to do that. So
Probably overworked too.
right, 100%. It'd definitely be a lot of work. So the thing is, most syndication groups have between 2 and 4 partners, and the reason they do that in part is one, to divvy up the workload a bit, and two, so everybody can focus on what they're good at. There's no point in having somebody waste time with something they're only mediocre at. We want people to be focusing on what they're exceptional at and what they're really good at.
So as a new syndicator, somebody just getting to the space, because you jumped right into syndications. Let me ask, how long did it take from I want to do syndications to closing your first deal?
So it took us about 2 years. I started looking at deals that we could potentially syndicate in June of 2017. And it was September 2019 before we closed our first.
And why do you think do you think 2 years is a normal pace, or is that, because I've met guys who have been in it for 3.5 years and haven't done their first deal.
I do think it's a normal pace. I think there's a couple things. So one is, I think it depends on the effort that you're putting in. If you had somebody who was in the position where they were able to go full time in it quickly, which, for anybody starting out, I wouldn't advocate that unless you have a significant amount of passive income or are independently wealthy.
Yeah.
But if you're able to put more time and effort in up front, I think you'll be able to do it sooner. But it depends on how consistent and how committed you are. So for me, I was consistently putting in 10 to 15 hours a week, even while I was working my full-time job. And I left my full-time job at the end of May 2019. As we record this, I still do have a part-time W-2 job. So I'd like to say I'm totally jobless, but that's not the case yet. And I put a lot more time into the syndication business. So at this point, I probably put 40 or 60 hours a week in it. And I jokingly say that I put a full-time effort in, but I don't make a full-time living. But soon enough, by the end of the year, I think I'll be in a position to do that. And it's just really the effort compounding and starting to see some results on that.
Okay, so whenever you decided you were getting into syndications, did you have a unit size or a dollar amount that you thought was your criteria, a reasonable amount, or did you just say, I'm looking for a deal with this return? It doesn't matter what the dollar amount is or the unit size.
So we definitely had a criteria. And one of the things we've learned since then is that we've refined our criteria. So sometimes as you go along, you get a little bit smarter and you learn different things. So when we first started, our criteria would have been deals north of 100 units and $5 million and up. And as we went on, we still prefer those properties, but we've also realized we're a heck of a lot less competitive on them.
Yeah.
And for anybody listening to this, if you're not aware, the real estate market is very, 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 very hot right now. And it is definitely a strong seller's market in most markets here in the US. And that definitely applies to multifamily as well. So what that means is for somebody who's starting out, or even somebody who's more established, a lot of times you're really not going to be competitive on those deals unless you're, really aggressive on pricing. And oftentimes you have to offer nonrefundable deposit money on day one as well. So those are usually things that'll be required to win deals in that size space. So we've had a lot more success in the 50 to 100 unit space. So we've kind of modified our search criteria now to be 50 plus units and $2 million and up. While we initially weren't intending to go that small, the benefit was twofold. One, it's allowed us to get some deals done. And two, it makes it a lot easier to raise capital. Many of us have the misconception that it'll be easy to raise capital once we get in there. And I think that's the natural ambition that many of us have as we get into different business ventures. But then as you get in there and you attempt to do it, you realize, wow, raising capital is a lot more time consuming and a lot more work than we thought.
Yeah.
And it's not going to be as easy as you thought. Just because people with money doesn't mean they're going to give that money to you.
Yeah. Fair enough.
It's going to take some time and some effort. So, for anybody out there, unless you have a proven ability of raising capital, I would tell you it's a heck of a lot easier to do a raise for a $2 million deal than it is for a raise for a $10 million deal.
Yeah. Okay. So what would if your advice to a new somebody looking to get into the syndication space, what should they focus more of their time on? Finding and vetting deals or raising capital for the deals?
Great question. So on that one there, I would say ideally you really want to focus on both. But what I would say is that I think having money gives you more opportunity, because there's a lot of syndicators out there that find deals that don't necessarily have the funding. And there's a lot of times where people wind up partnering with other groups, probably more than they care to admit. And I think by having the capital readily available, it does give you the option to pick which operators you want to work with and which deals you want to participate in.
What do you think is harder today, raising money or finding deals?
So I think it depends how experienced you are and what your skill strength is. For us, we're finding deals, and I don't think we're having too much of a problem with that. Now, part of the reason, let me be clear on this, is it's a lot easier to find deals in the 50 to 100 unit space. Once you cross that 100 unit threshold, and kind of the larger you go, the bigger the players you're up against.
And why is that?
So it's just because most times deals that are less than 100 units don't catch the attention of the institutional investors, the equity groups, and the big time players that are out. But once they're north of 100 units, then you have a lot more eyeballs, and a lot of eyeballs with a lot of money on them. So because of that, there's significantly more competition, and the competition is much more fierce. Whereas let's say if I'm looking at a 60 unit deal, my competition, so I'll give you an example. So a lot of the brokers that I dealt with in the Carolinas would tell me, for a 200 unit deal, they'll probably get 30 offers. For a 60 unit deal, they'll probably get 10. Oh. And on that 200 unit deal with 30 offers, there's a good chance that most of those groups are going to be very credible, and that at least a few, if not many of them, are going to include some type of non-refundable deposit on day one. And when I say non-refundable deposit, I'm not talking 20 or 50 or even 100,000 in most cases. A lot of times it's 250,000, 500,000, $1 million on day one. For me personally, I am not looking ever to put that type of money non-refundable on day one.
$1 million. Yeah.
Yeah.
I will say there is and I'm not going to contradict you because it's at a different level, but I did hear a broker, I was watching a video the other day, kind of explain why they're doing that, and it made sense to me, because what he was saying is the reason that guys that aren't putting hard money, or the reason that people are losing offers, losing bids, is because of exactly that. Like the hard EMD shows that you're serious. But the reason that people are serious is because they know they're going to buy the property before they even put in an offer. Like they don't need to do the due diligence because it doesn't matter. They have a plan. They're going to implement it. They know the market well enough that they could turn that, they could make it cash flow, make it meet the numbers before they even see the inside. Now, is that realistic? I guess you have to make a couple of hard assumptions on what the inside might be or what's the worst case scenario. They're just willing to take a higher risk. But if they know that they're going to buy it, they know they have the capital, they know the market works, they know the numbers work, then why not put in a higher EMD and make it non-refundable? I will say non-refundable means not refundable, but some of the literature I've seen means like if it's been misrepresented at all, then you do get your, right? It has to be as advertised, right? Or is it?
Let me put a caveat to that. So there's usually 4 standard carve-outs for non-refundable. One of which is exactly what you're saying, which would basically be seller default, for lack of a better term.
Okay.
But here's the caveat to getting that money back: the seller has to agree to it.
Yeah.
So even if you think that one of the standard 4 criteria was hit, the seller has to agree. If he doesn't, then what'll happen is that money's going to stay in escrow. Now you may eventually get it back, but it may be after a legal battle. Yeah. And most of the brokers I know, when I've questioned them, said that very few sellers, even if they legitimately are in the wrong, will agree to that and give the money back. Most times it will wind up in a legal battle. So what I would advise anybody is that, yes, it may be true that, it may give you some evidence that you're more serious. But what I would also tell anybody out there is you have to be in the position to lose that money if that deal doesn't go through. So in the event that you're not, you probably shouldn't be doing that.
Yeah, I think you have to be absolutely certain that you are capitalized, that you can close on this deal. If there's any question that you aren't, then now you're messing with money that you don't have up front, and you're going to have to pay it back anyway. So
right.
So and that's just as an example of that down in Panama City, where we invest. We just had to make a over asking 7-day close, all cash, hard EMD after 7 days after title, hard EMD after title search offer, just to get a 10-unit apartment complex under contract, because the market is so. I would have never made an offer like that. But right now the competition is hot, and I knew this is one market that because that's where I actively invest. This is one market where I knew, regardless of what the inside looked like, we would have enough renovation money to still make it cash flow very well. And it turns out that and the seller was up front, that half of the place is storm damage from the hurricane, and we kind of expected it based on the price. So now we, only half, not the whole thing. We'll be able to turn it around and make cash flow and raise the value quite nicely. But just a regular, it's already been renovated. There's not a lot of meat left on it, like a light value add. I'm not, you know what I mean? I'm not making that kind of offer because you don't know.
Yep, you're 100% right. It's a very competitive market, and it's a great time to be a seller.
Yeah, it is. I gotta apologize. I've got like a head cold right now, so if you hear me over here coughing or hacking or anything like that, that's what it is. Well, cool. So let's talk about the different, because you're at 204. You've done 3 units, 204 deals. Your first one was in the 92 units. So
92. Yep.
The last 2, what have they been deal size?
Sure. The second one was 48 units. That dipped a little bit below our 50, but close. And the third one was 64 units. So part of the reason we did those deals, one is that we like the deals themselves, but the other reason is we looked at it as a strategic building block, because they were both with different brokers that we were working with for quite some time. So we figured, let's see what we can do to build that relationship, and the deals make sense. So let's take them and go to the next level.
They all in the same geographical location?
They're both in the Carolinas, but they're a good 2 hours apart. So the 48 units is in Sumter, South Carolina, which is a tertiary market.
Okay.
And the 64 units is actually right in Charlotte. So that's all of about 7 minutes away from where I live.
And do you consider Charlotte a primary or secondary market?
I guess if you're going technically, it would be a secondary. Yeah. If you go by the strict definition, there's probably only 5 to 10 primary markets in the U.S.
Yeah.
So that would really narrow it down a bit.
Yeah, and I get whenever you're looking at primary markets like New York, San Francisco, all that stuff. But in my eyes, if it's got an NFL team, it's a primary market. You know what I mean? Like that.
I would agree with you on that. And in terms of overall population, Charlotte's actually number 15 in the country. So.
Oh, really? I didn't know that.
Yeah, it's actually, believe it or not, it's actually larger than San Francisco, even though San Francisco probably has definitely has more notoriety.
Yeah. Let's shift gears into markets and stuff. So what markets are you looking at? And then kind of do you have a minimum population? Do you have what metrics do you look at whenever you're analyzing a market?
The markets we really focus on mainly are throughout the Carolinas. We'll pretty much look anywhere in the Carolinas. Obviously we prefer Charlotte and Raleigh, but the challenge with that is so does everybody else. So it's oftentimes easier to find deals that make sense in a lot of the smaller markets. Initially, when we first looked at the deal in Sumter, I knew that the numbers checked out, but I was a little bit concerned that the area might be too small. And it wasn't until we actually went and we drove the area and toured the property that we really felt confident in it. And initially, as we started going down there. We were on back roads for about an hour and a half from Charlotte down to Sumter, a lot of which had limited cell phone service. So I said, well, if this is kind of where the property is, I mean, this probably isn't going to be a good fit.
Yeah.
But about 10 to 15 minutes before we got to the property, it started opening up and we had a nice little bustling city. So that gave us a lot of confidence saying, okay, you know what? This actually makes sense. So the MSA has north of 100,000 people. Generally, that's about as small as we want to go. We don't want to go too small because you want to make sure that you have enough jobs and enough population to be able to support the units that you have. So in this case, that checked out. Now, would I say it is a hard and fast rule that we would automatically disqualify a deal in areas smaller than that? No, but I think we'd have to see that there's enough demand within the area to really keep the unit strong and get whatever rents we're projecting. So sometimes there is an advantage to being a smaller area where you're one of the only multifamily properties in the area because there's probably still demand for that housing. And there's probably an opportunity to push rents because there's not really a lot of competition. So we really take it on a case-by-case basis, but the Carolinas are our primary focal point. Then we also look in Georgia, primarily Atlanta, and different parts of Florida. We like North Florida. We look in Jacksonville. We look at the Panhandle. We also like Central Florida, Orlando, and Tampa. So my biggest recommendation for anybody in terms of where to look, everybody has their own preferences, but to me, something that's very important is I want to make sure that I'm in a landlord-friendly state. So to me, I would never invest in anything with any residential component that's in a tenant-friendly state because oftentimes you're setting yourself up for a lot of difficulty and a lot of grief.
Yeah. One real quick, what are your thoughts on the Asheville, North Carolina market?
So Asheville's a great market. We've looked at some products there. Believe it or not, this may surprise you with Charlotte and Raleigh, but I think Asheville actually has the most compressed cap rates in the entire state of North Carolina.
Yeah. I love that place though. Like not from an investing standpoint. It is a beautiful area and it's cool. It's a really cool place.
It definitely is. And I think a lot of people feel that way. So the good news is even from an investing standpoint, what I like about that market is that there's not really a lot of new supply coming online. So because of that, you have a market with limited supply. You don't have an abundance of new supply. So that's going to inherently make properties more valuable because there's a lot of people that want to live there and they're willing to pay for it. They like the mountains, they like the views, they like the scenery and the weather. So there's a lot of things to like about markets like that.
100%. So what comes first, the market or the deal? And what I mean by that is, if you find a deal, now I look at the market to qualify the market, or do you look at the market and then look for deals to qualify the deal?
So I would always tell you the market's more important than the deal itself. And the reason for that is we can change the deal. If there's something wrong at the property, and I always tell this to our investors, I say, if there's a problem at the property, we should be able to correct that. There should be no reason why we can't. But we can't change the area. Yeah. We're not going to affect the market cap rate. Unfortunately, we don't have enough buying power just yet. We're not going to single-handedly clean an area up. That really takes a lot of moving parts. It takes political influence. It takes the support of the surrounding landlords and the surrounding property owners. And it takes a lot of different factors. So to me, the area is way more important because that's something that's going to be much more difficult for us to change.
Well, I guess the question I'm asking is, Charles Seaman wakes up tomorrow morning and says, I'm going to look for some deals. Are you looking at deals that are you going to a certain market and saying, I'm going to search for deals in this market? Or do you have deals coming in? And if it might not be in a market that and you say, I like this deal, now let me go check the market. Or do you say, no, this deal's not in the market that I know and like, I'm not even going to look at it?
I'll answer it two ways. If I was first starting out, I would look for deals in these specific markets that I'm focusing on.
Okay.
But now that I have at least a little traction, I'm usually at the point where deals are coming into me. What I'll do is I'll usually look at the deal anyway. Now, if I feel that the market just isn't a good fit for some reason, then I would let the broker know and say that, I don't think this market's going to work for us. Maybe it's too small or there's not enough jobs or whatever it might be. But most times I'll usually check the deal out because My belief is always the relationship is really the most important part. And because of that, I always like to look at anything a broker sends me and give them my honest feedback.
Okay. Now, are these brokers from those markets, or are they pretty regional brokers? Like they cover multiple markets?
They cover multiple markets. So what I would normally tell people is that in any given market, there's really only a handful of brokers that control the market. You have the big listing brokers, the Cushman and Wakefields, the CBREs, the Newmark Knight Franks, and you have a lot of the same brokerages throughout much of the country because many of them are nationwide and even global brokerage firms. So those are the ones that control the market. Now, as you're starting out, you may not necessarily be able to get their attention because they may be focusing on other more experienced clients. So you may need to start with smaller, more boutique firm brokers. But eventually, the sooner you can get up to dealing with the listing brokers, I would recommend it. So we'll deal with guys like from the Cushman and Wakefield team. They have a team in Raleigh and a team in Charlotte. So we'll deal with both. And what'll happen is they'll send us deals in those areas, but they also cover generally other areas in that part of the state. So it won't limit it to just Charlotte or just Raleigh. They may send us a deal that's an hour outside of Charlotte, but the same team is covering it because they're covering that entire region.
Now, when you see deals like, because I see deals from Cushman and Wakefield all the time, whenever you're talking about those brokers, the deals that I see are always, they never meet the criteria. They're always asking way too much, or they don't have a price on them. So I'm guessing they're vetting out any type of newer syndicators to make sure that they understand what they're doing in their own offer. But so you're saying you should make a relationship with those guys.
Yep.
Specific, like target them out specifically.
Yeah. So depending on your strategy. So if you're looking at deals 50 units and up, absolutely. If you're looking at smaller deals, I would say it's probably not as important. But once you jump into 50 units and up, and especially 100 units and up, absolutely. Those are the brokers that you want to be with.
And what's the best way to get their attention or for them to take you seriously?
Consistency. So I'll give you two answers: consistency and smoozing. They both go a long way. Consistency in the sense that looking at their on-market deals, even if they may not make sense for you, and getting back to them. So one of the key mistakes that a lot of people make is that they'll look at a deal a broker sends, but they won't actually get back to them and give them feedback if it doesn't work for them. That's a big mistake because then you really just wasted your time looking at it.
Yeah.
And being this is a relationship business, it's very important to get back to the broker and let them know that you actually looked at what they sent and let them know your feedback. For me, my feedback is always in the form of questions. I'll usually go back with 5 to 10 questions to let them know I looked at what they prepared. And then I further evaluate to see if the deal makes sense for me. And I'll let them know, listen, we can come closer in this, so we can come close. Then from there, the other thing I would tell you is that with consistency, eventually, if you start looking at enough deals and engaging with them and submitting offers, keep in mind, engaging and submitting offers is not or, it's and. You have to do both.
No.
What'll happen is they'll start to take you more seriously and they'll say, okay, this guy is actively looking. So eventually, you may wind up landing an off-market deal from them. It may take you 10 or 15 offers, so it'll take you some time, but they'll see that you're serious. They'll see that you're committed. They'll see that you're in it for the long run, and they may be inclined to give you a shot on something that you can close on.
There was a broker down in Florida that I really like. We submitted a first time we were making an offer on a larger deal in that area, and we walked the property. We sent out a guy. He went and took some videos because I'm out in California. I wasn't able to make it in time. And we submitted a LOI and pretty much got laughed off the lot, right? Like, because our investing criteria was not that of the larger guys in Florida. And the broker himself gave us feedback. He said, "Hey guys, look, I see that you guys are being active." He says, but here's why you lost this deal, and here's what you need to do to win deals. He says, you guys did a 1% EMD. He says that's really weak in this market. You know what I mean? It wasn't like he wasn't like tearing us apart. He was like, in this market to win, you need to have at least 25 hard up front, 25 after. after inspection, go hard, and then whatever. And then when I say bigger deal, I mean this is like it's $2 million, or bigger to us.
Yep.
And he gave us, he's like, remember last time we talked, it was the peak of COVID, and you had just gone through like 3 extensions to get a property closed. And your advice to me was or you and Brian were basically telling me, hey, you can put in your offer that you can have extensions up front. Right. I just lost a deal because I didn't have terminology like that. Well, the market has since changed. And what he was explaining is he says, you guys put in there that you would like to be able to purchase extensions for hard EMD. The reality is that made you look like you can't close in time. And right now, this guy's not price sensitive. He wants the assurance that he can close. And I thought that was just great feedback coming from a broker, because now, hey man, now we know what to expect. We know, is it a biased? Yep. You know what I mean? Like, I don't know if it was a biased opinion, because he had 10 offers. He had no reason to have to do that. He doesn't really need to fluff up what we're doing to get more offers. He had plenty of them. So right. I thought that a broker giving us feedback, I was like, well, hell, if he can give us feedback, we can definitely give him feedback every time he sends us a deal. So the relationship is definitely growing, and he is sending us deals.
And, those are definitely good things. I think you bring some good points. So there's different ways to win a deal. Price obviously is always going to be key for anybody. But other than price, I would say probably the number 2, and sometimes even the number 1 thing is certainty of closing.
Yeah.
And certainty of closing can come from different things. It can come from having a track record and being a proven closer, which goes a long way. If you don't have that, it could be a shorter due diligence period. It could be non-refundable money on day 1. So those are all things that help. Now, what I would advise anybody is that while those are all good things, just make sure that you can actually deliver on them. Some things are easier said than done. One thing I'm not necessarily keen on, although we just did it for the first time in 4 years on one of our deals that we just got, is we shortened our due diligence period. I really don't like shortening it much more than 30 days, because the thing is, aside from just doing your inspection of the property, what we also do is we use that time to get our offering docs ready for the syndication. And those generally take 2 to 3 weeks. So we want to make sure that we have enough time. Our goal is that by the end of the due diligence period, we want to have our loan application in good order at that point. And we want to have our syndication offering docs ready to go, so that way we can start raising money. So we went 15 days on this one deal because we were lower on price than the competition. But we shortened the due diligence period, and that helped a lot. And because of that and our relationship with the broker, we were able to get the deal, even though we didn't have the highest price.
Oh, nice. Like you said, it's not exactly about the price, because if somebody sees a high price, but they don't think that you can actually afford to pay it, then they're not going to take your offer, right? So that's right. 100%. And so one of the things that I wanted to talk about was, whenever you are submitting an offer in today's environment, I know you talked about you don't like doing hard EMD. Have you had to do anything creative recently, as far as like how you're negotiating now, other than dropping your due diligence period?
I think really your 3 points that you're going to negotiate, unless it's a seller who's open to some type of creative finance structure, which most larger sellers aren't. And quite frankly, it just doesn't fit their business model. Yeah. But if you're dealing with somebody who's more of a mom and pop operator, you can definitely get more creative, because a lot of times they're open to different structures that larger groups might not be open. So if you're looking at larger deals, your main movers are going to be price, shorter due diligence, and non-refundable money. Okay. Now, for us, we've probably looked at over 400 deals in the last 4 years, and we've probably submitted, give or take, 100 offers. And up until maybe 3 months ago, we never had a single one of them include non-refundable money. And we never had a single one of them included a shorter due diligence period than 30 days. So now we've had one offer include a shorter due diligence period. That one got accepted. And we've had maybe 3 or 4 include non-refundable day 1 money, only one of which got accepted.
Well, I would say your acceptance ratio has gone way up then, right? Because if you've looked at 400, made 100 offers, and have finished 3 deals,
Yep.
And now you've changed your criteria. 4 offers, 1 accepted, 1 offer, 1 accepted. You've got 100% acceptance ratio on one and what 30 or 25%. So
Right.
maybe it is time to I guess for us all to consider changing it up, because at the end of the day, without having any deals, you're not doing any investments. So
Right. I would agree with you on that. But now what I would tell anybody out there, especially for the non-refundable money, make sure it's money you could afford to lose, because there is a chance that the deal still may not get done for a different reason. Sometimes you find something out in due diligence that you just didn't expect, and you may not get that money back. Be prepared to lose it just in case. If it's money that's going to change your quality of life, you shouldn't be doing that.
And I think to be able to shorten your due diligence period, like realistically, instead of thinking as it and only in the sense of I have to hustle to get this due diligence done. There's a lot of due diligence that you can do on the front end. I think knowing your market very, very well, like knowing what the average turnovers are going to cost, knowing what the average construction costs are going to be in the area, what utilities. If you have all of your numbers in that market already at least closely understood, then you can shorten that due diligence timeline pretty quickly, because you don't have to do as much research. Like, what is the tax rate in this area? What is my my waterfall going to look like? What is, you see what I'm saying? So I think really understanding your market can help you feel comfortable shorten that due diligence period.
That is definitely one advantage to looking in the same market and having that market knowledge. And another advantage is having your team in place. If you have your property manager, if you have your vendors lined up, then it's a lot easier to make that due diligence period happen. You want to make sure you have all of your people ready to mobilize as soon as you get that offer accepted and the contract signed, so that way you can move on it. Now, the other thing I would tell you, at least for us, being that we like to have our offering docs ready, most times, probably 2 weeks will be about the shortest you're going to see those really come back finalized. So I think for us, 15 days is probably the shortest we would go on any deal with syndicating. If it was a deal that we weren't syndicating and we were doing more like a joint venture structure, then maybe you can go a little shorter, because then it's really just the inspection period, so you could speed that up.
Okay. And so you said you like to see a 30-day inspection period, and then you have your offering docs sent out. How long do you typically have for your capital raising period?
So we usually have 30 days for due diligence, 30 days to close after due diligence, and then we usually put a 30-day extension. So we'll shoot for 90. The goal is not to use the extension, but what I find is almost always we do wind up using the extension.
Really? Do you put in the offer that like the extension has hard money attached to it?
Yeah. So what we typically do is we'll usually put a 30-day extension in exchange for $50,000 deposit.
Okay. And seller's pretty receptive to that?
Most times. There's only one we've had that isn't. It's actually one of the deals we have on the contract currently. In that case, most times what we do is the $50,000 deposit applied as a credit to the purchase price. But one particular seller we were dealing with was not receptive to that, and he was willing to give us the extension, but it was for an additional $50,000 fee as opposed to applied to the purchase price.
Did you agree to it?
Yeah, we figured it's always better to have more time than less. So it's easier negotiating the extension up front than it is at the 11th hour when you really need it.
Yeah.
It always gets more expensive then.
So, well, I guess in the grand scheme of things, right? Like, I don't know what the size of this deal was, but if it was a 100-unit deal and like $10 million, $50,000 added to the asking price isn't necessarily going to change your
right
ROI. It's not even. It might move the needle, but not enough to kill the deal. So, from a seller standpoint, in a seller's market right now, I think it's a pretty good move on his part.
Right.
To be honest.
Yeah, at this point, the sellers are in firm control. So, oftentimes if you want deals, you have to play ball with them.
Yeah. Are you looking at selling any of your, would it make sense per your business model to sell any of your syndications at this point?
So we actually have our first deal as we record this here. It's late May. And about 6 days ago, we listed our first one for sale in the market. So it's on sale right now.
And that'll make you a full cycle syndicator on your first deal. Is that correct?
Correct. So it's something we're definitely looking forward to. So when we initially presented that deal to our investors, we projected a 2 to 5 year hold. If all goes as planned and we get the number we're shooting for, then it'll probably wind up being closer to an 18-month hold.
Oh, nice.
The good news is the shorter the hold period, the better your average annual return. So that way it makes your investors happier.
Yeah, yeah, and they get their money back. So let's talk about that though, because for anybody listening that doesn't know what a full cycle investor or full cycle syndication means, it means that you've acquired the property, managed it, and then sold it, and that's typically a 3 to 5 year hold. It could be longer for sure. It just depends on your strategy or your business plan. But if the market spikes up like it does now, and you can give your investors the return that you not promised them, but projected to them before, everybody's happy, right? So there's no reason not to sell it up front. And as a syndicator, right, Charles, like this is where you get the bulk of your payment is
Right.
at the sale, correct?
Correct.
So,
And the thing with syndication is that even though it's a balance between cash flow and appreciation, most syndications, even if they don't say it, are often more heavily weighted on the appreciation side.
yeah.
And the reality is, unfortunately, none of us can predict the market as well as we like to claim that we can. So it's to everybody's advantage to strike while the iron's hot. And when you have a hot market, unload something.
Yeah.
We bought at a time when the market was hot in 2019. I don't think anybody could have imagined, especially given a worldwide pandemic, how much hotter it could have been just 18 months later. But prices have gone up by insane amounts.
Yeah. Why do you think that is? Like, what do you think is flooding the real estate market with money?
There's a key word you said in that question, and that word is flooding.
Yeah.
So what's flooding the market in general is $6 trillion of new currency that was created in the last 14 months. So $6 trillion in new currency and historically low interest rates. The combination of those two things is spurring insane price action because there's a lot of new currency to be able to go to work.
Are you saying that the stimulus checks that were given out to everybody is the currency that was created to stimulate the market?
Yep.
Yeah. So all of that money enters the market. It inevitably ends up back in the hands of rich folks because they're the ones with something to sell. And
Right.
now they are taking that money and dumping it. But why real estate? Why do you think that money is do you see it going into stocks as well? Or do you think it's predominantly going into the real estate market?
It's going into both.
Yeah.
What I would say is, as far as where the market's headed, it's anybody's guess. I can make an argument why the overall market is going to continue heading up. And I could also make an argument why it's ready to roll over. Now, from where things are, my perception is that I do see certain real estate sectors taking a hit, but I see multifamily and industrial in particular remaining very strong. They were very strong throughout the pandemic. I don't think that'll change as things are reopening and getting back to normal, hopefully sooner than later. And as that happens, what a lot of people realize, and when I'm saying a lot of people, I'm talking institutional investors, I'm talking big time players, not players like you and I and many of the listeners.
Hey. No, I get it.
But the thing is, a lot of them who were investing in office and retail and other commercial sectors that got burnt during the pandemic, remember that.
Yeah.
And they shifted to multifamily, and they're probably not going to shift back too soon. So you have a lot of new players in the multifamily space that are willing to pay and can afford to pay very high dollar amounts.
Yeah, because at the end of the day, a place to live is one of the basic needs of every human, right? So we always have a customer. And I think office space, while it was cheap to own and you could do triple net leases and put all the expenses on the tenants and stuff like that, whenever you don't have any tenants because now everybody works from home, we got a lot of empty office spaces sitting right now with that I'm sure those people.
Right. You hit the nail on the head. So the key with multifamily, or probably with any type of residential, but multifamily in particular, is stability. Yeah. And that's the reason people invest in that.
Yeah. Well, cool, man. So one of the questions that I like to ask everybody that comes on the show is, because this is the Guerrilla State podcast, is what really bruises Charles Seaman's bananas, right? And what I mean by that is what do you think the biggest lie being told in the real estate game is today?
What I would say is and I'll focus this one on the syndication space specifically. And I wouldn't call it as much of a lie as much as maybe a fib. and what I would say is there is a lot of money in syndication. It can be very lucrative, but it is definitely more of a marathon than a sprint. And I think the biggest fib that many different educators put out there is the speed that you're going to see that return. And the reason I say that is because syndication is very lucrative, but it gets very lucrative once you can start sponsoring your own deals and raising your own capital. And for most people, it's not realistic that they'll be able to do that right away.
How many deals do you think it takes before you can begin to sponsor your own deals and raise your own capital?
Well, I would tell you I've done 3 and I don't have the answer for that yet. But what I would say in all seriousness is that I'm at least 2 years away from being at that point currently. And I would say I expect to have more deals done this year. So I think they'll definitely put us closer. But for most people, I think it's going to be until you start selling your first round of deals. And the reason for that is a couple of things. One, as you said, the syndicators are often making the biggest chunk of their money at the sale. So that's going to help a lot of people boost their liquidity, boost their net worth, and get some of the components they'll need. The second thing I would say is that having that credibility also establishes your track record. Not all, but many investors want to see you go full cycle on deals before they'll put money with you. And they want to see that not only are you in deals, but that you've actually sold some, and that instead of having projected returns to your investors, you actually have proven results and you can say, I've delivered X amount to my investors.
Makes perfect sense. Yeah. Well, okay, Charles. So I know that one of the things that I know you for specifically would be your ability to underwrite. I know that you give out some free sessions to people. If for anybody out there listening and is interested in learning how to underwrite larger syndication deals, how do they find out how to link up with you, to learn more from you, and what do you have for them?
Ramsey, I'm glad you touched on that. So every Saturday, 4 p.m. Eastern, we do a free session on Zoom where we underwrite a live multifamily deal. So if anybody's interested, you can text me 347-306-3278 or email me, Charles at 3 Oaks Management, the number 3, OAKSMGMT.com, and tell me that you heard me on Ramsey's podcast and that you're interested in attending the free underwriting sessions.
Awesome. And how long do those sessions typically go?
Probably longer than people would like on a Saturday afternoon. But they go 90 minutes on the short side to about 3 hours on the really long side.
Okay. And, well, I mean, it sounds like you get into the it's not just some overview of underwriting. It sounds like you actually get into the brass tacks of things and teach people how to do it, right?
Right. So what we'll normally do is we'll start with the underwriting of the actual deal that we're looking at that particular session. And then what we do is open it up for questions and answers. And oftentimes that can range on anything from underwriting to a broad discussion of the overall market.
Okay, perfect. So it's pretty much a mentoring session by you yourself every Saturday.
We can call it that. I've never referred to it in that way, but that sounds good. I like that approach to it.
Charles, you're too humble, brother. Where else can people find out about you? What about your investment? Anybody who's interested in investing with you, where can they go to fill out an application or find out more about your track record?
So the best spot for that, if they wanted to get on our mailing list and find out more info, is the website, 3oaksmanagement.com, 3oaksmgmt.com. And there's a spot that says invest with us. You can sign up on there and then you'll be part of our mailing list to get access to all of the different resources that we have. And you can also feel free to search me on social media. I'm usually active on LinkedIn and Bigger Pockets, and just search my name, Charles Seaman, Seaman.
Now, is 3 Oaks is the number 3 or is it spelled out 3?
So the company name is actually the word, but on the website for simplicity, we go with the number.
Okay. All right, cool. Well, Charles, man, it's been great having you on the podcast. Always appreciate talking to you and listening to your perspective. I hope you consider me in your network and brother, come back anytime.
Ramsey, it's always a pleasure. Thank you.
Thanks for listening to the Gorilla State Investing Podcast, where we give you the ground-pounding truth about what it takes to be successful in real estate. Learn more at realfocus.org/Gorilla State Pod.